Hello everyone, my name is Jason Castellan. I'd like to thank the Money Show for having us on here.
I'm Wayne Bird. And to run quickly through our agenda, just to give everyone an overview of what we're going to cover. We're going to talk briefly about who we are, who is Skyline. We're going to get into our 3 real estate investment trusts, and then our clean energy fund. And then kind of overlap with that, the strength of our funds and how we've been performing since inception. And after that, open it up with a Q&A.
So, just a quick overview. This is fairly well documented. If you want to go to our website, skylinewealth.ca, that's a place where you can, dig in a little bit more of our history. But we've put this up here to show you that we've been doing this for a number of years, for 20 plus years in the business, and how we've evolved our companies and our businesses over that time. So I think that's good for you to know and understand our track record, that we've really learned along the way how to build these businesses and these funds and carry them forward indefinitely for the future. So with that, we've got $5.3 billion worth of assets across our 4 funds that represent over $2 billion worth of investor equity. That's real everyday people that put their money with us to invest along the way, and then we break it down from there into our real estate products and then our clean energy fund.
I think through this as well, it's very important to understand and just provide the great background that this wasn't just created overnight and the idea to go in and create these funds and investments. This was created from the ground up and has real experience.
Yeah, I think, Wayne, we've talked about this, how we started with residential real estate and then we moved along into industrial, commercial, retail, clean energy fund. Those came about because we learned along the way, and we learned how to develop those properties. We learned how to run those properties, and then the energy fund. So it's kind of I think should give comfort to people investing with us that they know that we've learned this from the ground up and from the fundamentals up, and then we're going to continue to go towards in the future. So
as we start to get into our respective investment trusts, our funds. It's important for you to recognize and for us to recognize with you, our viewer. We're putting a lot of credence in that you understand what a real estate investment trust structure is. And while we are a private offering, we're in the exempt market space, we are structured, we're governed very much like a publicly traded fund. And from that, we then will just get right into our funds.
Yeah, so first one up here we're going to talk about is our Skyline Apartment REIT. So again, from the roadmap, we evolved from first student rentals in Guelph, Ontario, to actually then bigger, more efficient real estate like apartment buildings, where we would leverage with our investors to buy bigger, more efficient, more profitable real estate, and then build actual communities with our residents in those buildings to then lead into the Skyline Apartment REIT, which was launched in 2006 after about 10 years of buying one-off properties along the way. So today we're sitting currently at $3.1 billion in just this fund alone of assets. We are in secondary and tertiary markets. That's been our strategy since day one. I mean, Wayne's from Peterborough. I'm from Walkerton. Partners are my partner brother Marty is a small town guy too, and so is Jay Ashdown. We started with that background in our business, and we've just always stuck to that strategy. Being in those secondary and tertiary markets surprisingly has worked surprisingly well throughout this COVID experience because we aren't in those hot spots. We're kind of in the secondary and tertiary markets across Canada, which has really bode well for this. So as we look at our occupancy has been strong throughout this. We're growing. We're continuing to buy existing buildings. We're continuing to develop new buildings through multiple developers. We've got a lot on the go, and what we've experienced throughout this whole thing is that we are going to continue to grow at a very strong pace going forward. There's huge demand, huge shortfall for housing in Canada, and we're there to provide it, especially in those secondary markets.
Yeah, and the apartment REIT, while it's launched in 2006 at $10 unit price, it's now grown its way into a $21 unit price. It's yielding monthly distributions, and it goes through a process recognizing we are in the exempt space. We go through a process of at least, there could be 4 trigger points, up to 4 trigger points for revaluation, and we're looking at this on at least an annual basis. And no different to the apartment REIT as is with the other funds as well. There is a bit of a decorrelation between our exposure in the investment community and that of the public markets. And we believe very strongly that real estate is positioned extremely well in the private space.
Yeah, I think to understand, and I think we'll put this up front here with using the Skyline Apartment REIT as an example, our unit value is not created by the investment community's appetite. It's actually driven by the fundamental value of the real estate. So we're appraising that real estate, like Wayne said, at a minimum once a year, and then we're stripping away the debt, and that equity divided amongst the unit holders determines our unit value, which you see is currently at $21. As we continue to drive rents, drive value in those assets, then that equity will continue to grow. So you get the benefit of a distribution, around 4.5% distribution right now, paid monthly. Combining that with the $21 unit price, which has grown from $10 from its origination, that's how you calculate your overall annualized return, which we're showing there on the slide in front of you right now.
As the investment managers and the asset managers of the apartment REIT, in the early days, as we continue to expand our footprint across the country, we became more known in the entire investment community. And with that, that's where it really became the genesis for launching some of our other funds. So Skyline Commercial REIT, it being launched in 2010, was really created off of the apartment REIT. And it as well is well positioned across Canada. It has a more urban focus itself. It has to be located on high logistics, transportation routes, because that is where business gets business done. So this is another expanding portfolio. It is approaching $1 billion itself. It's got a great occupancy, and it's high logistic, high warehouse.
Mm-hmm. This fund is unique in that it was developed out of the fact that as we were gaining notoriety in the community and the investment community, we were seeing assets that were coming to us that were not only just apartments, but we were starting to get a look at some commercial industrial opportunities. And we at the early days, we were putting those in our fund. And the phone would call and an investor might say, hey, what are we doing? Are we an apartment fund or are we an industrial fund? So we decided, after gaining experience and getting good confidence in being able to operate the commercial industrial real estate within the fund, that we will put that decision of when you want to and who wants to own industrial real estate by creating its own independent fund. So we then dedicated the apartment to being apartment products, and now we have a dedicated industrial fund that's dedicated to light industrial real estate across the country as well. So it was an evolutionary thing that we did. We didn't just one day decide let's go with industrial. This was something we had in our portfolio, and it was an offshoot, and we grew. And you'll see that that's kind of the theme as to how we've gotten to where we're at today.
It's produced great returns as well, currently trading at $13.75 a unit. It goes through the same unit valuation. All of our funds go through that process. It's had a great return, great yield since inception, and it's also been very well performing through this climate in 2020 through COVID. And with that is a good basis for logistics and for one of our larger tenants being in freezer, cold storage.
Cold storage, yeah. So we've had a number of great experiences with this fund as well. As much as people need a place to live, they also need, there's jobs created from this fund that they're not our employees. We're the landlord, but there's lots of jobs that are necessary to continue to keep the logistics, keep the goods and services flowing throughout the economic pause we're kind of on right now until we get going again. So commercial REIT's great fund, performing well, and we see some great numbers through this, and that's only going to take us out the other end in a position of great strength.
So pushing this forward and thinking about how we have evolved through the real estate sector and what we've offered to our investors, Skyline Retail REIT launched in late 2013, but really with great impact in 2014, acquiring a portfolio and continue to grow and expand. Our strategy with this is very closely mirrored to that of the apartment REIT. Secondary markets, tertiary markets. However, with that, it's strong national brand, up to 70% national anchor, great tenancies in these smaller communities. And with it as well, being through COVID, through 2020, recognizing the strength that exists in grocery, pharmacy, quick service restaurants, banking. A lot of pandemic resilient tenants exist in our funds and has continued to perform very well, not only prior to 2020, but also through this process. So acquiring name brand in a secondary market has been a very great step.
Yeah, I think it's important. We've heard a lot of. I don't think we need to defend our model here because it's been performing greatly throughout this. But you do hear a lot of discussion around retail, and as much as the ones that you'll hear the big markets talking about is beds for apartments, sheds for industrial, so beds and sheds. We like to say with our retail, we like meds and breads. So pharma and grocery anchored has been the staple of our portfolio and has performed very, very well. And if people need a place to live and they need a place to work, they need a place to be able to get their groceries, their pharmaceutical requirements, their banking, their quick service restaurant, all that kind of stuff. So those are things that we've seen our retail REIT perform extremely well throughout this as well. So we're very happy with where we're at. We're happy with the unit value at $13.50, seeing a yield of 7.38%. Again, that's the annualized distribution on that $13.50 unit, but it's paid monthly. Or you can use a DRIP, distribution reinvestment plan, and you can obtain your returns that way throughout the fund. So it's a great fund. Breaking it down a little further, Wayne.
Yeah, getting a handle on what are we comprised of, and I know I alluded to it just a couple of minutes ago, in looking at the overall component of our tenancies, mm-hmm. to be very strongly anchored in grocery, general store, pharmacies, fast food, liquor, fitness, banks. It's been very strong performing, pandemic resilient, and also poised for continued growth.
Yeah, I think it's with all three of our funds throughout the last 6 months, we've closed on at least one asset in each and every one of the portfolios. So that's been a very good indication that performance is good, and we feel the confidence, and our investors have been there to invest with us on those acquisitions.
So looking at the benefits of the private REITs themselves, some of these will overlap into our clean energy fund. Jason touched upon this, and this is monthly distribution can either come by way of form of cash, EFTs, or enroll in the distribution reinvestment plan, the DRIP. So that happens, and that happens on a monthly basis. There's a capital growth potential. We addressed that in talking about our benchmarks for when unit valuation occurs, at least at a minimum on an annual basis. Tax efficiency potential, that's getting into our tax reporting and going through our annual report and issuing the T3 slips to our investors. We've always stressed with our investors that real estate is really a buy and hold. It's a long-term investment. It's a long-term play. And even us as investment fund managers and involved in the asset management side, we aren't flippers.
Right.
That's not to say that we haven't sold any assets, and we take those opportunities when they arise. We have had some dispositions occur across the funds, but we really are long-term buy and hold. And as I alluded to earlier in the presentation as well, generally historical low volatility, decorrelated from the public markets, being able to withstand any volatilities in the public market by being offering in the private space.
What we've made very clear with our investors from day one is that this is not we're not a short-term play. We take a long view on every asset that we acquire. So we're buying it. We're making substantial investments to further improve the property, to further improve and enhance its revenue generation, to build communities within those different asset classes, whether it be the people that work on site or the people that live on site, or the people that are the retail community that's on our retail plazas and things like that. We really want to foster and focus on a long-term relationship with all aspects of the business. So that's something that we've always say to our investors and find out, that we're lining up and aligning ourselves with the same common goal at the end.
Now, looking where we're at currently through 2020, through COVID, I know we've really touted it throughout our presentation already to talk about the strength of our investment performance during the past 6, 7, 8 months. The bar charts themselves are quite explanatory. We have done a very, very formidable job of collecting the rents, but not only have we done a very formidable job, our tenants have done an incredible job. They have all been very focused, determined, and committed to staying themselves in business, attract and take the assistance that's available from governments, etc., and knowing that rent is a key component as well.
What we've learned through this, I mean, we've been through the financial crisis in 08, we went through 2012, the dips in the markets and along the way, and then now the current pandemic that we're going through right now. The performance through this has given us the confidence to go forward. We have to continue to build on our model. Our model has proven itself that it works, and that it's sustainable, and that it can be profitable through all types of scenarios. So we're very impressed with the way things have gone, and we're going to continue to push forward on this. So we're moving then to the Clean Energy Fund. Seems like a little bit of a step outside of what we've been doing in the past. However, we've been using clean energy and solar on our buildings since 2012. Back in the day in Ontario, when the governments rolled out the microfit and the fit programs, we saw that as a huge opportunity to create new sources of revenue streams, and then more recently to offset utility bills and rising costs of utilities. If you are following the news anytime now, you're seeing that that's already increasing. So the Clean Energy Fund is well established in our portfolio, and again, something that we used that we were doing on all of our assets in the retail, commercial, and apartment funds to create our own institutional size fund going forward. And the Clean Energy Fund has been our most recent product, but we're seeing huge opportunity as we go forward. So we're up already now to 42 assets in the fund. It is a little bit different, Wayne, than what we do with our apartment, commercial and retail as far as distributions. We want to talk about
from
that.
a distribution standpoint, the Clean Energy Fund is an equity investment, a pure equity investment. And by saying that, we are taking the income generated from the fund and we're warehousing it and turning it into the next round of acquisitions. There's a lot of opportunities for growth, for development, for reinvestment within the fund itself. So by warehousing and keeping those investments, keeping that income and redeploying it, what we then have done is we're going through and we're doing a monthly process of unit valuation. So we're taking that and we're actually going through a monthly unit valuation and then continue to communicate that through to our investors. It's just our process of growing the fund. I
think, Wayne, like the technical way, I think investors like to know and understand behind the scenes. So that money that we earn from our solar revenue currently on those assets that we have, that comes in, it's cash. Then we convert it to an asset, and that asset, because we're taking that cash and we're buying more assets, that's what grows the unit value for the investor. When we're distributing the cash and on the other real estate funds, that's going out the door back to the investors, and that's what it's designed to do. This, we took a different approach to it, and we want to keep that money and we want to grow it and compound it on a month-by-month basis, because these things earn revenue monthly. So it's been a great model. We've seen some substantial growth right away. We've got lots of opportunities, lots of runway, and with the way the world's gone now, we are seeing a lot of investor interest in this category. So it's been a really good producing fund for us. So Skyline, who we are, we're grounded by real estate. But we've moved into infrastructure with the Clean Energy Fund. We stay private by choice, so that's something that we've felt through the emotional cycles. Whenever we hit the financial crisis, or we hit there's volatile things in the public markets, we've been able to, because we value our units at least annually, we've got good stability and low volatility through those times. So we're staying private by choice, and that's something that I think has boded well for us, and our investors can sleep peacefully because of that. And we have a history and track record of performance. It's been we've been doing this. We're not an overnight company. We've been doing this for a long time. We bought our first rental in 1991. So we've been doing this and only this for all of our working careers. So this is something that, when you want to talk to any one of us in the company, we know this business from the ground up, and we're here to happily speak with you about that.
So looking at this, and just kind of to wrap up a couple of pieces as well, and just really stress on the structural standpoint, on the governance standpoint, is if you as an investor are thinking about putting some of your equity with Skyline and one of our real estate investment trusts, our clean energy fund, and looking at us against a public peer, just recognize and understand that our structure, our governance are actually the same. It's just us stepping away from the public market and being able to create and forge these one-on-one relationships, whether it's us or whether it's our wealth advisors, our Skyline Wealth team. They're the ones that will work directly with you, help assess what is best for you, where you would like to see your equity put into, and then continue to forge that relationship, grow with you, and be in constant contact.
Yeah, I think because this is the Money Show, I think it's appropriate that we talk about money. And one of the things that throughout this process, we hear of the massive government printing of money and the massive dilution that's going into the system. If each one of us had $1 yesterday and now there's $2 in circulation, I know this is a broad explanation of this, but your buying power has been cut in half. Your money has been diluted. So what you want to do is you want to be into hard assets. You want to be in things that are tangible, like infrastructure, like real estate, like other hard assets that are available out there. So I think that that's something that, as we've seen this play out, there's been increased, just increased money out there. We see the price of lumber going up. We see the price of vehicles going up, and because of that, we're seeing rent go up. So those are things that we're experiencing, and by being in those assets, we're going to benefit from the upside, from the rents, from the net income, which drives the value in those assets, which drives your unit value. So there's a big domino play here that plays through our whole investment structure. But we've certainly seen that now more so than ever, we're very, very bullish on our funds, and we're going to be out there, lots of growth, lots of opportunities, and taking advantage of those.
With that, I know that we've kind of thrown a lot of information at you in a relatively short period of time. It's going to take some time to kind of digest, but at this point, we'll probably open things up for some questions and answers. Thanks.
Thank you.